definitely.
All right. As we were looking at this in terms of what was the probability of that rate cut coming, and back when we did our update there in August, Matt, on August 7th, it looked like we probably weren't getting a cut down to 2.5 until December. And it was at that point, it was still only a 67% chance. And that changed drastically by September 15th with that 68% chance that we're going to be getting our 2.5 there in September, and then up to 92 by. So it was coming. At that point, they knew it was coming. We didn't know for sure based on this if we were going to get it in September, unlike we have some other information that kind of is happening anyway. But look at the change there just in the matter of a month.
Yeah, the statistics came out after the October 7th. And we lost 66,000 jobs. And I think ultimately that's probably what tipped the scale here for a sooner cut. And as far as the second cut coming in, again, I think the trade war uncertainties have something to do with it. And I think that Canada's thinking that inflation is going to come down a lot what we're expecting right now. I have confidence in their forecasting. But I guess we'll see what happens.
Okay. So one of the things I'd like to talk about, because now this is going to get adjusted again, of course. That's just the way these things. But there's been talk with both of you and who you're seeing on your end, the different economists that you guys are consulting with, that there's a chance that we hit another cut before the end of the year, potentially, that would bring us to 2.25. Now, again, on here, we're looking at September, as of September 15th, just a couple days ago. Likely that we were going to see that in January. Now, personally, whether we see that in January and December, I don't think it makes too much of a difference. But what do you think? It could be either one, or do you think that we're leaning more to getting another cut before the end of the year?
I think the beer is going to be core inflation in the jobs market, and whatever they do next month is where we're going. If they both weaken, or if inflation comes down and jobs losses increase, we're getting cuts. If they stagnate or move to the other side, then I think they're going to hold. I think these two are going to come into significant play now.
Agreed. Yeah. Agreed. I think with the information, again, we have available to us right now, it is quite possible that we'll see that possibly by the end of the year. But I completely agree with Matt that, that could tip the scales as soon as that information comes out, for sure.
So Nicole, as we pivot more about the bond yields, which are impacting our fixed rates instead of these Bank of Canada announcements, they're really impacting our variable rates. What are you seeing on your end for buyers right now in terms of what they like to lean to? Are they leaning more towards fixed rates? Are they exploring variable? What are you recommending? I know it's case by case basis, but what does that look like to you in terms of those conversations you're having?
It is definitely case by case, but the overwhelming majority has now swung over to that variable rate side. And it's been a big shift because in the year, even though we knew that probably made the most sense for most people, again, it is very individual, but still just overall, it was. But then when you have a conversation with clients and you explain to them and you understand that, of course there's a guarantee, but if we do think that the likelihood of these potential decreases, are on the benefit of the rate allows you that flexibility to potentially buy you some time to be able to lock in. So that is the mindset, I think, of a lot of people, that it's not even so much taking the variable rate and we're like, yeah, we're going to, waive over the next 5 years. It's that we're just going to buy us a little bit more time to see how things go. The spread between the variable rates and the fixed rates are very minimal right now. They're palatable, right? It's not a big, so people are kind of really towards. And then over the last little while, the more information that becomes available that we are expecting to see these decreases, like in the last week and a half, I had so many clients call me, oh, Nicole, I think you are right. Let's switch that and switching it before yesterday's announcement. So,
yeah. And so what I think key takeaway there is that once you choose it, you don't just sit on it and say, I'm good for X amount of time. You've got to stay in touch with yourself to know what are we doing now, the new information that we get next month or 6 months from now.
Exactly. And that's the biggest thing, because a lot of clients get, or they have uncertainty. How am I follow this? There's no way I'm going to wake up every morning and look at the, the bond market.
And nor do I want to.
Yeah, exactly. Right. So, but is the benefit of having somebody like myself or you guys, in people who have understanding, is that I speak to my clients on a regular basis to kind of stay in touch and let them know. And I do say to them, I'm never going to be able to call you and say, okay, hey, today's the day, we've got to lock in. I wish I could, but that's just not, feasible. It's not, because they'll have, the inside scoop speak. in terms of what we think is coming, then, you know, they're able to at any point in time that it makes them feel comfortable. And that's the key thing. If we think that there was at least going to be a little bit of relief based on what they were locking into or what they could possibly lock into now, then, you know, we can just monitor and see how it goes.